say Allison. Born and raised in Akron, Ohio. Grew up with the north side. My occupations are on a real estate company right now, J Real Estate LLC. I partner with ACN and also work at FedEx full-time.
Sorry about that.
I was born with a learning disability, but I didn't let that stop me. I had a lot of dreams and ambitions, so I just was looking for answers, and I didn't let that stop me. Football, sports, definitely what got my drive going. Football is probably my favorite sport. I feel like it teaches the best lesson of getting hit, getting knocked down, be able to get back up and keep going. So I feel like that really taught me one of the best things I could possibly learn. And I was just always determined to be different. I never wanted to follow the crowd. I just wanted to be myself and be different. Next slide. Some of the things I'll be talking about today is assets versus liabilities, renting versus owning, and my personal experiences on real estate. All right, first thing is assets and liabilities. So, have y'all ever seen Baby Boy? You ever seen Baby Boy? So there's a scene in Baby Boy, and the stepdad, Tyrese, he got his little business going, he making his money. Stepdad comes in the room, and he's like, you got your business going, you get your money, but you gotta learn some rules to the game. Tyrese's like, what's these rules? He said, man, guns and butter. Guns and butter. He's like, what's guns and butter? All right, so the butter is, the cars, the clothes, stuff that don't mean nothing after you buy it. Now the guns, that's the real estate, the stocks, the bonds, the artwork, stuff that appreciates in value. So what he was referring to is assets and liabilities. He dropped the biggest gem in that movie. A lot of people probably missed it. So using myself as an example, I got a Jeep Grand Cherokee. Dope. Got the double sunroof, touchscreen, press push button start, paid $19 for it. My payments is $398 a month. And I got like a 72-month loan. At the end of the day, I'm gonna be paying out $28,000. And when I'm done paying it off, my truck is gonna be worth like $12,000. So I'm gonna be losing a whole bunch of money. So that would be labeled as a liability, because there's a lot of money going on in my pocket. You know what I'm saying? It's just money, basically. But now, asset, I own my second property. I paid $4,000 for it, and I paid $6,000 into it. So at the end of the day, $10,000. Now I'm getting $600 in rent every month. Now you times that by 72 months. I mean, you do the math, and that's just 6 years. So, a house lasts a lifetime. So do 600, times, 10, 15 years, and I mean, that's a pretty big number. And it's just gonna keep growing. Just money is going into my pocket, and I'm not even doing that. Next slide. Some of the myths about buying a house is a lot of people think you have to have a high credit score to buy a house, which is not true. To this day, I own 3 houses. My credit score is still not even all that good at all. When I first bought my first house, I had a credit score of like a 615 or something like that, and I still got approved. But I just kept trying. I kept, I was trying to go to bigger banks. Unless you got a really good credit score, like Huntington, all those big banks, it's gonna be hard to get financed. But if you go to like a mortgage company or a smaller bank, they work more of, people that don't have a high credit score. So that's one of the myths of buying houses. You don't have to have a real high credit score. Income. You don't have to have a high income. When I got my first house, I was only making about $11 an hour, which is not that much at all. And I still got approved for a house. House repairs, that's another thing that people think, oh, I don't want to buy a house because I got to pay for repairs and this and that. That's not necessarily true, because if you have home insurance, you put in a claim, they pay for it. Now, my first house, the roof, it was a bad storm, my roof was done. It was like $10,000 in damage. I don't have $10,000. I had my insurance, State Farm. I said, my roof is all messed up. They like, dropped the check, got the check in a week, got my roof fixed. So that's definitely one of the big myths too, is if you have some insurance, some home insurance, you don't necessarily have to always pay for repairs. Some of the benefits of renting versus owning. When you rent, only thing I can really come with, you got a place to live. For if you're just renting. Now, if you own a home, every year you pay, as long as you're not late on your payments, your credit score is going to go up. So your credit increases every time you pay your monthly plan. There's tax cuts. So at the end of the year, when you file your taxes, they send you a W-2 for your mortgage. I get it every year, and you get a tax cut for it. Home equity. This is huge right here. I bought my first house. I paid $50,000 for my first house. 3 years later, I got a appraisal. They appraised for $100,000. So I only owe $50,000. It's worth $100,000. So I got $50,000 in home equity, and this is money you can borrow. You can use to fix up your house. You can use to buy a car. All type of stuff. It's
Question, sir.
Definitely great.
What exactly is equity?
Equity is what you owe versus what your house is worth. So, if your house is if you owe $50,000 and it's worth $100,000, you got $50,000 in equity, which is huge. And also, when you pay a monthly payment every month, a portion of that money goes into an escrow account. So you also build money that way too. Buying is cheaper than rent, like hands down. If I have a 3-bedroom house, 2 bathrooms, it's 1,000 square feet. A house it's in LA. A house in LA renting for that rents for $1,000 a month. My monthly payment is only $610 a month, so it's way cheaper. Plus, I'm getting way more benefits from it. When after you pay your house off, when you die, you can leave it to your kids. I love a family one. You own it, so you can leave it to whoever you want to after you pass away. Your landlord free. I had the worst experience with landlords, raising my rent every month, always complaining. I don't like landlords. So that's the definitely plus side of owning a house. And if you're investing in in property, you can generate income. Just like I was saying, I have 2 investment properties, and I'm getting income from that every month. So you can create income, passive income, from getting a house, owning a house. And next one. All right, so like I was saying, I bought my first house 3 years ago. Some great lessons I learned from it is it's definitely not difficult. The process is not bad at all. It took me about I think it was like 3 months to close on my house. If you have a great realtor like Tony over here, you make sure everything is straight, you're good. You can make sure the process goes easy. I bought my second house the next year, and how I bought my second house is just cutting my liabilities. So I downgraded on my car, basically penny pension. I downgraded on my car. I stopped going out to eat as much. I just started really saving some money, and that's how I was able to, buy my first house at $4,000. From just cutting my liabilities. Because if you add up the stuff that, if you buying Jordans, buying designer clothes, if you add that stuff up at the end of the year, it's so much money. And then once you buy some Jordans, once you buy some designer clothes, you're never going to get that money back. You're basically throwing that money away. And also paying rent too. If if you're paying rent for 10, 15 years, you're just making your landlord richer. So cutting my liabilities, that's how I was able to buy my second house. Now my third house, I had a whole bunch of equity. Like I said, I bought it for $50,000 and it was worth $100,000. So I had $50,000 in equity. So I went to my mortgage company. I'm like, look, can I do it's called a cash refinance. So basically what I did is I refinanced my house for $80,000, I only owe $50,000. So they gave me $30,000 in a $30,000 check. So I used that to buy my third house that I own right now. And I'll be generating, it's a 3-bedroom house, so I'll be getting between $700 to $1,000 in rent. And my payment, it went from $580 to $610. So basically I pay an extra $20, to get $30,000 to make $700. So I can pay my whole house payment and have some money on the side. You know what I'm saying? Got some little extra money. So that's the best thing about, you know, home equity and being able to have resources for you know, to do different things with it. You can, like I said, use it to fix up your house, anything else you can do with it. Is that the last slide?
That was your last slide. So, anybody got any questions so far? At any point, you know, we can ask questions, have an open dialogue. Go ahead. You want to know what credit is? You want to take it away?
What's a good definition of credit? Basically, your ability to pay back, you know, money borrowed. If somebody borrows some money, you pay it back, your credit score goes up. If you borrow some money and don't pay it back, credit score goes down. And you know, the banks and stuff, people that want money sees that and they like, you know, if he's paying his money back, oh, let's loan, you know, we can loan him some money. He's trustworthy. Now, if you're not paying your money back, he's not trustworthy. We can't let you borrow the money until you know, you learn how to manage your money better. So that's like the best way to put credit.
Excellent question.
So that very good question. So yeah, that entails for me. So we have my guy Tony next to speak to you guys. All right, Tony, the floor is yours, man.
All right. So I'm more so going to get into the specifics. Isaiah did a great job as far as giving you his own experiences in real estate, what he's learned, what his process looked like. So what I'm going to do for you guys is give you a step-by-step process on what that's going to look like for you as an individual. So a little bit about myself. My name is Tony Blackmon. I was born in Canton, Ohio, but grew up in Akron several years. Ended up finishing up at Canton McKinley back in 2008. Ended up leaving high school, worked a bunch of different jobs. Really was just trying to find my way. And I always knew I wanted to get into something that I could be working as an independent contractor, being my own boss. So ended up getting into a real estate course at the University of Akron back in 2010. And did that for a few years, ended up getting a job, working different jobs. And back in 2015, I had the opportunity to partner with one of the largest real estate firms in the US with Keller Williams. Worked there for about 2.5 years, transitioned to Key Realty here in Fairlawn earlier this year. And also back in 2015, I partnered with a real estate development firm which focuses on buying properties, fixing them up, putting them back on the market, and renting those properties out as well. And just about myself, I enjoy working out, spending time with family, traveling, and my whole purpose in being in real estate is to obviously accumulate some legacy pieces as far as assets, to free up my time from working day to day to doing this right here, which is educating people like me, educating community on things that I wasn't educated on. So that's really my goal as an individual. Here's the next slide. So here's the outline. We're going to be talking about the step-by-step process of buying a home, investing in real estate. We're also going to be talking about how you can sell real estate. There are different avenues you can take when you want to sell your house in real estate finance. So the first step in purchasing a home is to just speak with a local realtor. Most real estate transactions in the market, 95% of them is handled by a realtor. Now the main thing when you pick a realtor is you want to work with somebody that you can trust, work with somebody that you feel like is going to have your best interests. And the reason I say that is because most people, when they look for a home, they drive down the street, look for a house with the for sale sign in it, and the realtor that they see on the sign, they're going to call that realtor up and ask for some assistance. Now, what most people don't know is that the realtor you see on the sign is working for the seller's best interests. So let me ask you guys, what do you think the seller's best interest in that transaction would be?
Getting the most money.
Getting the most money. You as the buyer, your best interest is what? Save the most money. So when you interact with that realtor, they're going to get you to try to pay the most amount of money possible. So you want to get you a realtor ahead of time so that way they can let you know what that process is going to look like, and they're going to be an advocate for you as a buyer's agent. and they're going to negotiate on your behalf. Now, right out the gate, I get a lot of feedback that some people think that working with the realtor is going to cost them money. Actually, how much money do you pay me to represent you?
Zero.
Free. It costs no money to work with the realtor as a buyer. The only time you pay a realtor is when you're a seller. You pay them a real estate commission at the closing table. It might be 6% of the purchase price. But other than that, it's just basically agency disclosing the fact on who's representing who in the transaction. Now, before you even get to looking at homes, you want to make sure that you have a pre-approval letter or the cash already in your bank. So what that looks like is if you don't have a bunch of cash sitting in the bank, what you're going to be doing is sitting with a mortgage expert that can get you the financing to purchase that property. Now, the good thing about working with the realtor is that your realtor is going to have relationships with bankers that are going to fit your needs. So if you don't have $10,000 for a down payment, your realtor a lot of times is going to have different lenders you can work with that will offer no money down programs, 3.5 down programs, things like that. So that's another benefit to you as a buyer. Now when you get your pre-approval, you can go with a bigger bank like Chase, Fifth Third, Wells Fargo. Those kind of banks are okay, but the interest rates that you're going to pay are probably not going to be as flexible, and they're not going to have as many programs if you don't have a lot of money to put down on the home. So I always advise people to go with a mortgage company, a smaller mortgage company, because they have a lot of programs that fit your needs as a borrower. As far as the companies, mortgage companies, they offer varied funding options. And then once you get your pre-approval letter, now the pre-approval process, you basically have a conversation with your lender. It can be over the phone or in person. It takes about 10-15 minutes of your time. They ask you certain questions about your occupation, what your credit score looks like. And I know most people, they're real hesitant on getting to this step right here because they think, oh, if I apply for a mortgage, it's going to hurt my credit score. And what most people don't know is that you're actually allowed up to 7 credit pools when you're trying to get pre-approved for a mortgage within 30 days. So if you get your credit pulled a couple of times, it's not going to impact your score significantly at all, as if you were. Now, if you were trying to get approved for a credit card, that's a different situation, but for mortgages, it doesn't really hurt you that bad. So just wanted to kind of dispel that myth. Slide. All right, so once you speak with your mortgage banker, they're going to let you know what you're approved for. It could be $50,000, $100,000, $500,000, whatever the case may be. You're going to get a letter in your email or your mailbox saying that you're approved for XYZ. Now, the reason you want to obtain that, the reason it's so important is because if you just skip that step and go right into looking at houses to write an offer to purchase, remember those realtors I was telling you about that's working for the seller? They're going to ask you to provide a pre-approval letter to prove that you can actually execute on that deal. And if you don't have that letter, they're not going to accept your offer. So it's very important that you get to that step first, and then you work with your realtor to help you find properties that fit your needs. So when you write an offer to purchase, here's what that looks like. Your realtor is going to make sure that the property you're buying is worth the amount that you want to purchase it for. So they'll actually do a market analysis, see what homes are actually selling for in that area. And then let's just say the price you agree on is $70,000. You'll write an offer to purchase for $70,000. And then typically in this market, you want to put earnest money in a deposit. So what earnest money, anybody know what earnest money is? Okay, so basically it's a good faith deposit that you leave with your real estate broker or with a title agency, and it comes off the purchase price at closing. Only thing that it does is show the seller that you're actually serious about executing on that transaction. You're not going to be wasting your time. So you put earnest money down. It's negotiable, anywhere between $500 to $1,000. It can be less. It's just all negotiable. I've actually done deals with no earnest money. It just depends on the seller and the broker you're working with. So from there, you want to actually negotiate the terms. What can happen is the seller can accept your offer, they can reject it, or they can counter offer. You know, maybe you offer $70,000, and then seller comes back and says, well, we'll take 72 with more earnest money. Bunch of different things. You're not really going to be working directly negotiating with the seller. It's going to be your realtor negotiating with the seller's agent. And then once you get through negotiations, hopefully you get your offer accepted at the price that you like. And then from there, this is so key, and you definitely want to get a home inspection. Reason for that is because there can be a lot of things that can be wrong with your house that you're buying that you can't see just with your naked eye. There can be things that within like the foundation, there could be termite damage. So you want to hire a general contractor or a home inspector contractor to inspect the property from top to bottom. And that cost can range anywhere between $400 and $500 depending on the company you use. And now, when you get your home inspection, you're going to get a home inspection report. And there's going to be an itemized list of things that the inspector found in the property, or just things they feel that you should fix before you actually purchase that property. Now, what ends up happening is you can actually go back and renegotiate terms with the seller. You can have them, before we purchase this property, we're going to ask you to fix the roof or replace the windows, or whatever the case may be. Now, the seller, they don't actually have to fix those things. They can decide to. They may decide to fix some of them. They may decide to just tell you as is purchase. Now, if you're not okay with that, you can actually back out of the deal and get your earnest money back. So now, you're not going to be able to get a refund from your home inspection, but at least a $500 investment, could have saved you $5,000 down the line because you could have bought a property where the roof was bad. So that's why I say the home inspection is very important. All right, so now after you get your offer accepted, your bank is going to be working on getting you the financing, which is the credit check, which they already did up front, and then your loan is going to go into an underwriting process. So basically, that's just their language they use as far as making sure that the money you had in the bank is legitimate. They're going to source your funds, all those kind of things. They're going to hire an appraisal on the property. Does anybody know what an appraisal is? Yeah, so basically it's a third party that comes in and makes sure that the property is worth what it's actually worth. They just look at properties that are actually sold in the area comparable to yours. You're going to get a survey. It's a third party company that comes in, measures around the property to make sure that you know your land begins and ends. And then definitely get insurance. Isaiah touched on that earlier. Definitely make sure you get home insurance on the property. Now, when you're getting financing from the bank, they're not going to loan you the money without insurance. Now, if you're purchasing property cash, you're the bank. So you've got to make sure you get that insurance because nobody's going to make you do it. If you buy property without insurance and your house burns down, it's on you as an individual. So that's very important. All these things you see right here, if you're getting funding from a bank, they're going to demand that you get these things. Otherwise, they're not going to give you the funds. And all these things really are going to be paid at closing. So your appraisal costs, your appraisal you'll pay up front. That's like a $500 fee that you pay in the beginning. But all these other things like the survey and the insurance, you're going to pay like 6 months worth of your policy at closing. And then your title search. A title search is basically a title company or an attorney making sure that the person you're negotiating with, the owner of the property, is actually the owner, and they're going to make sure the property doesn't have any liens or judgments or any mortgages on the property, and that they can be paid off at closing. And there are fees included in that as well. So definitely talk to your realtor to know what those fees are like.
If you have a situation where you do the title search, where it does come back that there's liens or something else against the house at that point, is there an opportunity to back out of the deal at that point also once they do that, or are you kind of in the house at that point?
Good question, excellent question. Depends on the contract, depends on the realtor you're working with. A good realtor is going to make sure that your contract says that this offer is contingent on good title, good marketable title. So if, in fact, in the end, the attorney finds that there's a a lien from 1800 that needs paid, or somebody has other claims to the property, your contract should state that you can back out of the deal or renegotiate with the seller to take care of that issue before you close. So you can definitely back out of it as long as that language is in the contract. And most brokerages that do business with buyers, it's already written in the contract ahead of time. So yeah, when they do a title search, they're going to make sure that there's any encumbrances or liens removed, and they're going to make sure you get title insurance. So that way, if in fact the attorney missed something down the line, so let's just say you bought a property and then 2 years later, the old seller had a brother that had claim to the property, they're claiming ownership to your property, your title insurance will pay for that cost to take care of that other party. So that'll protect you in the long run, that title insurance. And that's another thing to think about. If you're buying property cash, make sure your title company includes title insurance, because if you're buying cash, nobody's going to make you get that title insurance. Go to the next slide. So yeah, once you get through inspections, negotiations, and all that, you're going to obtain the funds. Your bank, or if you're paying cash, is going to wire the funds to the title company, and your title company is going to disperse the funds where it needs to go. They're going to pay the seller, pay the insurance people, whoever is included in that transaction, and you close on the property. You get the keys. You take possession of the home. And these are my past clients I worked with in the past. Next slide. Now we're going to talk about investing in real estate. This is my favorite part. For anybody, everybody's always asking me, Tony, how do I get involved in real estate? I want to invest in real estate. And this is the simplest way you can actually be an investor in real estate and actually get paid for owning the property. By taking advantage of the FHA 3.5% down loan program, you can purchase a 2-unit property like a duplex up to a 4-unit property. 4 units is still considered residential. And as long as it's residential, you can actually utilize the FHA 3.5% down. So I say if you're an individual thinking about getting into real estate, take advantage of the program, because you can buy, in this market, you can buy a 4-unit building for under $100,000. You live in a 1 unit, so let's just say a $100,000 mortgage is going to run you, let's just say $700 a month. If you live in a 1 unit and rent the other 3 out, in this Akron market, you can rent a unit out for $700. So you got 3 units that you're charging $700. You're getting $2,100, and your mortgage is only $700. So you're getting paid just to live. You living for free or for cheap, and you get to be the lord of your land, reap the benefits of property ownership, all the benefits that Isaiah talked about earlier, which is your principal pay down, your equity build up. Now, if you're a young family or a person who doesn't want to live in a unit, this is just maybe a sacrifice you got to make temporarily, because you can actually move out of this unit and get another property, and then rent the unit that you were living in out for another $700. There's no stipulation that says you have to live here for the rest of your life. And you can repeat this process multiple times. So this is like my favorite way to get involved in real estate investing. Any questions on that? So there are other avenues in regards to real estate investing. Before I move further, you can get into buying and fixing and flipping. You can buy a house and rent it out. I prefer not to get into single family residences as far as using a mortgage. If I'm gonna buy a single family home, I'd rather use cash or maybe using somebody else's money as far as like a private money lender, because when you have a mortgage on the property and you're trying to rent it out, the mortgage is gonna kill your cash flow. So we can kind of talk offline if you want to get into other strategies as far as fixing and flipping, just for the sake of time. But now we're going to talk about selling your home. If you want to get into selling your house, there are different avenues you can go about that. You want to first examine your motivation for selling. Everybody has a different motivation. Now, if you're looking for market value or quote unquote retail value for personal reasons, such as Maybe you're upsizing. Maybe your family is getting bigger. You're having a newborn. You want to get a bigger home. Maybe you want to fix up and improve your property to cash out your equity. So if you got a property where you got maybe 50 grand in equity, you can go ahead and borrow against that equity and get a better place or fix up that property. Now, these three right here, you're going to be looking at more so to get the highest amount of money possible that the market would bear. From here on down, if you're a seller who's going through a divorce, maybe the property has deferred maintenance, maybe there's tax liens, you're behind on payments on your mortgage payment, maybe you inherited a property from your grandma that passed away and you don't really want to deal with that property, seeking retail market value may not be your best option, because if you're distressed, time is kind of working against you. So you might want to have to seek professional help and find a real estate investor who's going to actually buy the property from you directly and pay you cash and close in 30 days or less. Now, when you work with a real estate investor, you're not going to have any real estate commission fees. You're not going to have to sit on the market and wait for somebody to buy your property. They're going to buy it in as-is condition. So if the property has deferred maintenance, the roof is falling in, they're not going to ask you as a seller to make those repairs. They're going to fix that property up themselves. So there's different ways you can kind of examine how you want to sell a property. Just wanted to kind of break that down for you. Next slide. So again, realtor versus an investor. A realtor is going to represent you. They're going to put your house on the market. You're basically just paying for marketing. They're just soliciting for buyers to come make an offer on their property. They're going to charge you a real estate commission fee. You can range anywhere between 6 and 7% for the service. And you got to keep in mind, there's no guarantee your property is going to sell by sitting on the market. You know, that's just the reality of it. Not every buyer is going to want to buy your property. Maybe the seller is asking too much money. Whatever the case may be, there's just really no guarantee. All you can do is price the property appropriately and put it on the market and do your best to market it. So that's how a realtor is going to represent you. They're going to look out for your best interests, and you're paying for that service. As an investor, they're going to offer you a cash.
Oh, real quick.
Yeah.
I was curious, in regards to the realtor statement about them charging the commission, are they paid regardless whether the house sells or not, or is it once the house sells, the realtor reaps or receives payment?
Excellent question. I can't speak for all brokerages, but the brokerage I work for, if the house doesn't sell, no harm, no foul. Some brokerages work different. Some require some form of payment if the property doesn't sell. So that's why I say in the beginning, if you decide you want to sell your home, talk to at least 2 or 3 realtors to see what's the best fit for you. And then if it's in your best interest to not be charged if the house doesn't sell, then you might want to work with whatever realtor is going to offer that service for you. Great question. So an investor is going to offer you cash, as I stated earlier. They're going to close in 30 days or less. And this right here, people really lean towards this because if you're a person who's going through a situation where they cannot afford to sit on the market for months and months and months and wait for a buyer because they still got to make their mortgage payment, they got to make repairs on the property, they live out of state, they'd rather just go with an investor so that way they can get that quick solution and get the money in their pocket. They buy in as-is condition, so you're not going to have to worry about the buyer. See, a lot of times buyers can sometimes ask for the seller to pay for the inspection. With an investor, they're not ordering any inspections most of the time, and if they are going to order inspections, they're going to pay for the inspection. And they're going to save time and money, the speed of it, closing in 30 days or less, no commission, no repair. So a lot of times, that can save a seller thousands of dollars depending on the condition of the property, because they can also pay the closing costs of the seller as well. And it's just peace of mind, knowing you don't have to deal with that property anymore. Go to the next slide. Now we're going to get into real estate finance. So with the mortgage process, we're going to give you the outline of what you can expect, credit qualifications, how do you know if you qualify, what programs are out there, low to no down payment, and how much money will you need to bring to closing. So the first step, I kind of touched on it earlier, you're just going to have an initial consultation to speak with the mortgage banker. Another myth I want to dispel, how much money did you get charged for just talking to a lender when you bought your first house?
Nothing.
It costs no money to speak with these professionals. So if you want to talk to an attorney, an accountant, whatever the case may be, it's free. If a professional tries to charge you just for having a conversation, you need to go find another professional that you want to deal with. So basically, they're just going to talk to you about your financial goals. They're going to do a credit application with you. They're going to collect personal documentation such as W-2s, bank statements, things like that. Your tax returns, and then from there, that 30-minute conversation will get you, 15-20-minute conversation can get you to a pre-qualification letter, which is going to be critical when you are making offers on homes. So once you get your pre-approval letter, I'm reiterating this right now, you get a contract, your realtor will send the contract to your banker, your realtor is going to kind of guide you through that process. You're going to get your mortgage loan disclosures. Basically, it outlines the important terms and details of your loan as far as your interest rate, your escrow account, things of that nature. They must be signed by all borrowers before closing. They're going to order appraisal. We kind of talked about this already. You can go to the next slide. And then the underwriting process is basically them finalizing and verifying all the information that you gave throughout that process. Your loan profile will be reviewed by an underwriter who will give you an approval, conditional approval, or denial. So this part right here, the denial part, if you're a borrower that is getting a loan for a home, and let's just say they see that you got a car in your name, you got a credit card in your name, they're approving you based upon your current credit status. Now, if in the middle of your home buying process, you go out and buy another car, or you go to Vegas, or you use your credit card a bunch of times, you go applying for different credit cards, this is going to negatively impact your score, and you're going to end up getting denied. So if you buy a home, if you're trying to buy a home and you go out and buy a car, you're going to end up with a car instead of a home. So it's very important that you don't make any huge deposits in your bank account. You don't do nothing silly with your money, basically, where you could end up losing out. Go to the next slide. True or false? You need a 700 credit score to purchase a home. As you can see, what is the minimum credit score needed in order to obtain financing? What do you think?
It's on here.
It's on there? Okay. It's on there.
I think I have below a 600. I'm not gonna lie. My credit score is not high at all. And I got approved. So if you try different companies, mortgage companies and stuff, some people will work with you. People will definitely work with you.
The minimum is 580. I've seen some mortgage companies go lower than that, but if it's lower than that, then your interest rate is going to be kind of high. But yeah, just shop different lenders. If one lender tells you no, try another one. It's not going to hurt your credit score that much. You're allowed 7 credit pools when you're trying to get a mortgage. So definitely be aggressive in finding the best kind of financing that's going to fit your lifestyle. Go to the next slide. 580 credit score generally. Now with a 5, you want to aim to be at least above that, because that's like the lowest of the low, and a lot of companies may not qualify you based upon that. I've seen it get done at 580, but you want to at least be at a 620 or better. But you can definitely get financed at a 580. It's like the minimum. So there are 3 different credit reporting agencies and lending institutions that are used to qualify you, which is Equifax, Experian, and TransUnion. Now, each one of these credit bureaus, they don't communicate with each other. They don't share information. They are basically reporting what's actually on your credit. As far as your credit cards, they are in touch with you or your creditors. And each bureau can provide a different score. So Experian could be like a 620, Equifax could be a 700, and TransUnion could be a 710. It all depends. It's just different processes that they use to determine your score. Mortgage lenders will use your middle score or your FICO score to qualify you. Now, your FICO score is not the one where it reports what's in the middle. It's basically the simple way to figure out what your FICO score is to cross out the highest one and the lowest one, and that'll be your FICO score. So that's an easy way to remember. Just find your highest and low score, throw them out, and that's your FICO score, and that's what mortgage lenders are going to base your qualifications on. Next slide. Credit qualifications, different industries use different algorithms to determine your credit score. So if you're shopping for a car or a credit card, they're going to be using different algorithms to figure out if you're qualified or not. You can actually buy a car with a 400 credit score. Now, you might walk out the car dealership with a skateboard, but you can definitely still qualify with a lower score if you're trying to get a credit card or a car or anything like that. Now, when you're trying to get qualified for a car or a credit card, most of the time they're going off of your Vantage score, which is what shows up on Credit Karma. Credit Karma is the worst thing you can do to look for your credit score. The best way to find out what your FICO score is to go on, what's the website? Annualcreditreport.com. You get a free credit report. What's that? It's .org. Free credit report. I think. Yeah, okay. You get a free credit report once a year, and it gives you all three bureaus, Equifax, Experian, and TransUnion, and it gives you a breakdown of what your credit looks like. And that'll be your FICO score, and use that score to kind of see if you can qualify for a home loan. Now, the FICO score breakdown, this is like the most critical piece of information that I've learned being in the industry. Payment history. Having a history of paying back money over time makes up 35% of your overall credit score. So for a person who has a credit card for 7 years, never close that credit card, because that's the majority of your overall credit score. If you cancel that card, it could be devastating to your overall credit score. So your payment history, as long as you have a good payment history, your credit can be decent. Even if you don't have multiple credit cards or trade lines, as long as you have a good payment history, that does you wonders. Amounts owed makes up 30% of your credit score. So the higher your credit limits, the better your score can be, because it shows creditors, it shows lending institutions that, wow, Isaiah, he has a $10,000 limit, he could probably qualify for a $100,000 loan. Versus somebody who only has a $500 credit limit on their credit card, it kind of shows that you might not be ready to take on a bigger responsibility. So amounts owed is critical. So if everybody right now, Facebook, if you have a credit card right now, call your credit card right now, your company on your credit card, and tell them you want a credit line increase. All you can do is ask. All they can do is tell you no. If you get a limit on your credit card increased, it puts you in a better position to where if you have an emergency, that you're not maxing out your credit cards. Because if you max out your credit cards, they actually hurt your credit score. It shows that you are desperate for money. It shows that you don't know how to manage your money. So here's another gem I'm gonna leave you guys. Never go over 30% of your credit card balance. So if you have a $1,000 limit on your credit card, don't go over 30%. Creditors look at anything over 30% is considered to be maxed out. So just by paying your credit card balance down below that 30%, it can actually increase your credit score. Your length of credit history is 15%. Types of credit cards used. Basically, you want to have a mixed profile. You want to have a phone bill in your name. You want to have multiple credit cards. You want to have, different loans, personal loans in your name that are in good standing, a good credit profile mix. This is maximize your overall credit profile. And then there's new credit. New credit is about 10% of your profile. So this was key for me in increasing my credit. Just understanding what impacts your credit score. You could have like perfect payment history, but if you have a $900 balance on a $1,000 credit card, it could kill your score at 5,200 points. So just by paying that credit card down, like, it's very important. We'll go to the next slide. And true or false, the information is already in your packets. You need 20% down. I actually covered it earlier. It's not true. The minimum that you need down, next slide, please. 3.5% down. So 3.5% down on a $60,000 mortgage is only $2,100. We spend $2,100 on fast food. You get $2,100 at tax season. So you can use $2,100 down to get you a $60,000 house. In the city of Akron, you can get a nice home, decent home in the city for $60,000, move-in ready. So basically, 3.5% down is $3,500 per 100,000. Go to the next slide. Different loan programs. You can go conventional loan program. It's a standard purchase loan. It's about 20% down. Most people that have a lot of money prefer to use this program because you can put more down and pay back a lesser loan amount. Plus you get, a little better rates if you're going conventional. FHA, Federal Housing Association, what FHA stands for, that's your 3.5% down. And then if you're a veteran, you can utilize the VA home loan where you can put no money down. And then the USDA loan is basically only for properties that are in rural farm area. You can qualify for a no money down loan on that. So for the conventional loan programs, the minimum credit score you're going to need is a 620. Minimum down payment requirement is 5%. So anywhere between 5 and 20% is what your conventional loan is going to look like. Conventional loans follow fairly conservative guidelines for your credit score, debt to income ratio, loan to value. So they're a little stricter in regards to how much debt you have versus how much income you have coming in. They're a little bit more strict. They don't have as much flexibility when it comes to your credit score and loan to value. Does anybody know what loan to value is?
The value of the home versus the loan amount? Yeah,
basically. So, like with the FHA loan program, if you're getting a 3.5% down loan, you're getting a 97.5% loan to the value of your home. So if you're getting a $50,000 loan on a $100,000 house, it's a 50% loan to value. The FHA loan program, FHA is a government-backed program, which means easier approval. Basically, they wanted to get more people to buy houses because it improves the overall economy. All you need is a 580 credit score to qualify. Minimum down payment is 3.5%, and it's insured by the Federal Housing Association. And it's great for first-time home buyers due to lower down payment requirements. The VA is also a government-backed program, which makes it easier for approval. It's guaranteed by the VA. Minimum credit score is 620. That can vary depending on the lender you use, and it's a zero down payment requirement. So it's for active duty veterans, honorably discharged, or retired veteran. The USDA loan program is another government-backed loan, which makes it easier for you to be approved. Requires zero down payment, minimum credit score is 620, and is guaranteed by the USDA. So I have you guys today. So any questions, anything that you want me to explain a little further? Anything that comes to mind? All right. Got a question?
Yes. So why should you buy houses to get money?
Why should you buy houses to get money? That's a good question. You can use a house to buy it to get money. You could buy a house, make it real nice and pretty, let somebody live in it, and then they can pay you money for living in it every month. Did that answer your question? All right. Well, again, guys, I want to thank you for coming on out today. We're at 1:30. I don't want to take up too much more of your time. If you guys have any questions that come to mind regarding real estate, financing, whatever, you got my call, you got my information, and give me a holler. I'd love to assist you with your real estate endeavors. Thanks for coming out, man.
Appreciate that.
My pleasure. My pleasure. I hope you gained something. You know anything?
This one did. I think, moving forward, something I'm gonna kind of align our goals to, start, so I'm kind of digital prepping. Like I got some things I gotta take care of. Like some debt to income. I got some debt clear up beforehand. I think that's gonna help me out in terms of like interest rates and things like that. Experience, or just investing in whatnot, but I mean, y'all do kind of inspiration. You said you're in the third house now, and I like how you broke it up. I'm trying to get her on it right now. Like I want to have a long thing that I kind of want to think about. Be going into like a duplex or some, it's like a multi-million. Kind of get like a property, like you said, kind of like that. And yet, being a Christian family, I don't know how best she is to do it. Because I mean, we need a little bit of space right now. I think right now it's technically a 2-bedroom, 2-bath, but it's got a full basement. So right now I'm kind of making it. I got my daughter, my son. I got to go get a room for sure right now. And this one probably in the I think after that, I don't know. Space wise, but I'm really like ready right now. So I can do that and sort of prep myself for maybe a couple years down the line, get my own property and attacking that to the side. But, I mean, you gave me a lot to think about. And everything, so I can start, moving in that direction. How old are you? That's great. There's a lot of us out here that just have black cars over home. And I think, like I said, just think it's not possible. The man is I'm only on the roof, relatively decent. And it's just, I think I'm just lucky here, but so I'm not going to be paying more. So it's just, I don't have nothing to show for it. It's real stressful.
It's a process, bro. You got to start from somewhere. You got something to work with as far as information. I know you said that there's something to work with. One bite at a time, bro.
Oh, yeah. I got it mapped out now, so it's just, it's not difficult. I mean, I'm already actually working on it right now as we speak, so that's something I'm planning on. This is exciting to me a little bit. And I wanted to get some more information also. I think that's been tempted. I haven't read it. Really say, I don't want to take real estate. I know. I got my market and things like that. And then that's the other thing. I can make a lot of stuff. No, I got a lot of stuff on kind of factor here right now. I'm dealing with that. I was under contract in the house, and now it's just like, put me under contract on the house, and I was ready for money, but my mortgage company had drafted me my paperwork to
I don't know, like.
I got a dude, his name is Russ Allen, it's American Mortgage. He's a mortgage company, he's finding the best of them. That's why I was glad. Like I said, I was making a lot of money, the price was high. He found me a lender, a good lender, you know, I'll pay down. I'm there, I was 2.5, I put on like 2%. And I got an FHA loan. It all went up.
You said it was American Mortgage?
Yeah, American Mortgage. It's like, you know what Thomas Circle is? Yeah. It's right before Thomas Circle, right by Chevy 17.
Okay.
You might, I think you might have moved though.